Hi, I'm Roger Montgomery and welcome to this week's Video Insight. Well, let's start by summarising Trump's approach to deal-making, his presidency and the commercialisation of the White House. I heard someone say what Trump does is create a problem and then solves the problem he created by undoing the thing he did, claiming credit for the end result, which is, of course, nothing. With that out of the way, and by the way, there's a decent hint in there about how to take advantage of Trump's apparent chaotic approach to foreign relations, let's take a look at the US bond market. While it's not making waves right now, it could be the next source of volatility and portfolio reweighting. US Treasury bonds are the backbone of global finance, safe, reliable, and a key indicator of market health. Right now, the yield on US 10-year Treasuries is sitting around 4.5%, which is significant because it's the threshold the Trump administration seems keen to keep a lid on. The catch? There are forces at play wanting yields to climb higher, and that's why things could get interesting just as everyone catches their breath from all the tariff and trade war disturbances. The US government has been injecting massive liquidity, around $6 trillion since early 2024, into the financial system. How? Through a strategy that leans heavily on short-dated Treasury bills, which are like quick one-year loans instead of longer-term bonds. This approach, combined with the Federal Reserve drawing down its reverse repo facility, has flooded markets with cash. It's Clayton's quantitative easing. Think of liquidity as the lubricant that keeps the financial wheels turning. It supports stock prices, lending, and more. It's been a form of Treasury-led QE, effectively monetizing the federal deficit. The Fed's contributed about $2 trillion, while the Treasury shift to bills has added another $4 trillion by reducing the dollar duration of its debt. This liquidity surge is a boon for markets. 80% of global lending now relies on collateral like Treasury bills, which banks love because they're less demanding on balance sheets. But here's where it gets dicey. This strategy could be stoking longer-term risks. Bond yields are under pressure because some investors, those called bond vigilantes, will inevitably demand higher returns to hold long-term debt. Why? They're worried about the US's growing debt pile and the sustainability of this bill-heavy approach. Indeed, the term premia, the extra yield for holding long-dated bonds, is creeping up, signalling rising duration risk. And if 10-year yields break past 4.5%, we could see volatility spike, which would crimp the collateral multiplier that drives liquidity. Liquidity would decline, and with it, support for stocks. Now let's layer in some external factors that are adding fuel to the fire. First, Donald Trump himself. Despite President Trump's claim of reducing the federal deficit, data shows the deficit has been increasing. For fiscal 2025, which started in October and runs to September, the US budget deficit for the first 5 months reached a record $1.147 trillion, with February alone showing a $307 billion deficit, up 4% from the previous year. This increase occurred despite efforts by Trump's administration Department of Government Efficiency, or DOGE, to cut spending. Second, the US debt ceiling. This is the legal limit on government borrowing, and it's always a political hot potato. If Congress stalls on raising it, markets get jittery again, pushing yields higher. Third, Moody's recently downgraded the US credit rating to AA1. It's not a catastrophic change to the US credit score, but it flags concerns about rising debt levels. And finally, the Treasury plans to buy back $50 billion in bonds by early August to manage debt maturities. This could tighten the supply of long-dated bonds, further pressuring yields upwards. So what's the takeaway? Well, the bond market is a bit of a crystal ball for the economy, liquidity, and the appetite for risk. Rising yields could make borrowing costlier, slow growth, and debt stock prices. And while the Fed's sitting on the sidelines for now, a yield surge or inflation spike could force their hand. Either way, the bond market's signalling some caution, and it's time to keep an eye on bonds. Well, that's all we've got time for today. Continue to follow us on Facebook and X.